Hello everyone, welcome to Smart Investing. I hope that you had a very good weekend. This Monday, you can see the market is up. Yeah! So you see, you have just to be patient and you will see a rebound in the market. I told you over the last 2 weeks, we were seeing a clear bottoming process. And from here, we should see a recovery. It doesn't mean the recovery will go to all-time high, but the probability that we'll go much higher than we are today is extremely high, especially when all the uncertainty will vanish, and then we will go through April the 2nd, and we will see that a lot of negotiation will happen between the US and the main trading partners. Because don't remember, if the US is planned to go into recession, a lot of these trading partners will go also into deep recession, and they don't want to go to deep recession, especially if you have a surplus. If you have a trade surplus with the US, you are the one who will suffer the most. This is clear, and I don't understand why people think that if they flee to the European market or to other market, international market outside the US is going to protect them, because they are going also to be impacted by tariffs and all these trade wars. So I am staying and I'm sticking to my US and mostly US technology investment, because I believe it's the future, and whatever tariff or whatever short-term uncertainty there are, I think it doesn't matter, because we are going to a new world. This new world is about AI, technology, robotics, all this third industrial revolution. And this is where the money will be. There is no doubt about this. If you have invested in technology over the last 10 years, you will beat everything that is moving in the market. No doubt about this. Even Bitcoin, if you think it's part of the technology changes, technology and innovation, it also beat everything in the market. So you see, it's all connected. We go into a new world. If you don't understand the new world and why it's going to change dramatically what we are doing every single day, I mean, use a lot of the AI like Grok, ChatGPT, and a lot of AI tools that you can see already in the market. It's changing the way we do everything every day. We are so much more efficient writing letters, writing contracts, doing this DCF analysis and doing everything. Before we had a lot of Excel and all this. Yeah, and I don't understand why people do a lot of YouTube doing discounted cash flow with the Excel. Because you can ask Grok or ChatGPT or whatever other AI that you are using. They will do it in 2 seconds. You want to shock the variable, you can do it also. They will do it in 2 seconds. But this is not where the added value is. The added value is not being able to do a DCF analysis, discounted cash flow analysis. Everybody can do it. It's very simple, As long as you understand the maths, it's very simple. But anyway, this is not the subject of this video. The subject of this video is we are going to see 1, 2, or 3 video about the market. We're going to make some comments, and hopefully we're going to get some lesson from this video. So let's get into it.
One of your next guests says the markets will find their footing before April 2nd, when the reciprocal tariffs, at least for now, are set to take effect. Joining us now for more is Tom Lee. He is the head of research and founder of Fundstrat, also a CNBC contributor. Also joining us, Nancy Tangler, Laffer Tangler Investments, CIO and CEO. Tom, listen, I understand it's a different White House. Every day we get a market-moving headline. A lot of people, I think, honestly, I'm just going to say it, they don't want to be neutral. They don't want to be data-driven. They want to be angry. I get that. But history says that markets will recover, right?
Yes, they've recovered every time. One thing we have to keep in mind is when markets fall this quickly from a 52-week high. I mean, just remember, less than a month ago, we were at all-time highs. That is a market pricing in a crisis. I'd say we're almost 50% pricing in a recession, and we're assuming there's no Fed put. Now, the Fed is in a position to cut rates. That really should mitigate the downside. And I do think 2 other things that investors have to keep in mind, because many people just want to get out until April 2nd, is number one, I do think there's a very high probability that a tariff solution happens before the next 3 weeks happens. And it's simple to see because China, Europe, Canada, Mexico, since April 18th, all of those countries have outperformed the U.S. I don't think that markets are that blind to say if Canada and Mexico are about to have a recession, they should outperform the U.S. And I think the second thing people should keep in mind is that when you have a global crisis brewing, and we highlighted like the 1962 Cuban Missile Crisis, That was a 12-day crisis, but the markets bottomed 7 days into the crisis. 5 days before that crisis ended, the market was already recovered 2/3 of the losses.
And that was only, Nancy, nuclear holocaust. I mean, that literally was, we're going to break the world in half with ICBMs. I mean, that was, compared to tariff worries and a slowdown in the economy because we might slap something on European wine or steel, seems very small now. That said, again, and I'm not saying the markets are going to recover next week. I don't know. We're talking about history, and I don't like to bring up politics, Nancy. It always makes me feel like I need a shower, but I will ask you this. How much of this correction that we are seeing do you think, 100%, 50%, 0%, is political, is man-made, is tariff-made?
It's funny you asked that, Brian. It's good to see you. If you look at the consumer sentiment numbers today, and I commend everyone to read Kelly's piece that she wrote this morning, but if you look at behind it by political party, what you see is that Democratic sentiment has not been this low, especially on expectations, ever. And so if you look sentiment overall by party, Democrats down from 91.4 all the way down to 41.4, while independents and Republicans are down somewhat but have held up. And then on expectations down from 28.2 down from 93.1 to 28.2. So that's driving some of these sentiment numbers that the market's keying off of. And I would just point out that the bond market is not panicking. And so this notion that we're going to go into recession because the Atlanta Fed GDP Now number was revised down, that was driven by imports. They were up 70% in January as purchasing managers trying to get in front of tariffs. So I think just like in 2022, this will all settle in. We are seeing decelerating growth, but that's good for many of the names that have been punished, the reliable earnings growers in technology and consumer discretionary and some financials even. So I think we will continue. This is a correction. We needed one. We get one every 12 months. And so now the question is, have we hit the bottom? Do we have a little more to go? But I don't think we're in a bear market.
Okay, that's the first video. They also agree that the bottom is very near. And we see clearly a bottoming process in the market. And the market should recover from now. Also, what they're saying also is that all the noise about tariffs and all this is nothing compared to what we've seen in the past. So if you are panicking already for a 10% correction, 15 or 20% correction, like for example the IWM, then there's something wrong with your mindset. You shouldn't panic. This is all normal. Like she said, every 12 months we have a sharp correction in the market. Then it's good to have it at the beginning of the year, because that means for the rest of the year we're not going to see that much correction, you know. And this is probably what will happen. When you see already a downside of 20% IWM, do you think that another 20% downside from here is possible? Of course, I don't think so. I don't think so. We've seen already. I've shown you where IWM is. Also for the QQQ, for the high tech, for the Max 7. Max 7 already corrected by 20%, 22%. I showed you on the previous video. Do you think they're going to correct another 22% without any major catalyst that would justify another 20% downside from here? I don't think so. I don't think so. These are the best company in the world. You know, you have to understand these companies are growing earnings every single year, even during downturn, even during the recession. They are bulletproof, you know. Of course, some of the Max 7 like Tesla is highly volatile. And you can have a lot of question mark about Tesla. But the others, they are extremely reliable technology company, you know. Other than that, what they were saying is that usually the market bottom before the event happened. So the market always anticipates something that will happen in the future. So that's a lesson you need to understand also. So if you expect things going to be better in the next 3 months, the market already will bottom today and start to recover before we even have the proof it will improve in the next 3 months. Is the market always work like this? I don't think there is any sign on the economic data that we're going to see a recession. I showed you over the last 2-3 weeks, all the economic data doesn't show at all a sign of recession. The probability of recession is always there at all time, minimum 25% at all time. The Fed has said it clearly during the last meeting. So if you see a probability of recession slightly higher than 25%, it's not a dramatic. I know they will grab a lot of headlines, they will make a lot of fears in your body, but then you're going to start to panic because you see all this downside plus this type of probability of recession. but it's all normal. You should really get familiar with all the economic data and historic data, so then you don't panic for nothing. Also, what you see is all the bearishness in the market. When the bearishness is so high in the market, so much bearish, that we have to go back to the October 2022, when the market crashed by minus 38%, to get that same level of bearishness, only because the market corrected by 10, 15% or 20% for the Max 7. When you have so much bearishness, there is not much room left for the market to go down again and again. Everybody who wanted to panic and sell, they already have sold. So you have to understand the game. It doesn't mean the market cannot go down from now, but you need catalysts for the market to go down. It cannot just go down like that magically because nothing is happening. All the tariff talk already baked in the price. What is new now, from now, that will warrant another downside of the market? All the tariff risk, tariff uncertainty, tariff talk, all the geopolitical with Ukraine, all has been baked in. Unless you have something very major and very different that will happen in the market, that will make the market fall again, then the market will not fall. Earnings are still positive. No recession in sight. No sign of recession in sight. So again, try to be confident. Don't panic. Don't overreact. Have a longer term view of the market. And don't play this game of fear mongering, because a lot of these commentators, they want to be fear mongering. A lot of the headlines, they are fear mongering because they are there for you to click and to panic and to overreact. That's how they make money. So you have to understand the game, Don't fall for this trap, Okay, let's watch the second video.
Our next guest says the Fed put is alive and well, and that's one of 4 positive signs he's seeing for the markets this week. Joining us is FundStrat's head of research, Tom Lee, also a CNBC contributor. Tom, it's good to have you, and let's just kind of start with that theme, and maybe you can build on what Steve just told us. How do you interpret the Fed's move yesterday? Welcome.
Well, I think markets were positively surprised by the Fed's move, in part because recent staff papers from the Fed had argued tariffs would actually be multi-year inflationary effects. So Fed Chair Powell's comments yesterday, I think, did catch a lot of folks by surprise, just because it is a view that markets probably want to hear, that they'd like to hear that the Fed is viewing tariffs as possibly transitory, because that puts them in a position to actually intervene if labor markets start to weaken. And in fact, that's evident in the SEP, because 90% of Fed staffers now see not only risk to growth, the GDP growth forecast, but it was 90% seeing it as downside risk.
Steve, would you agree with that characterization, or how do you think the Fed or Goolsbee or a member like that might respond to the idea that they're still at the ready to support the economy?
They're at the ready to support the economy through keeping rates where they are right now. He kind of took off the table, or never has put on the table, this idea of hiking rates. I think it's a difficult and very interesting dance the Fed has to do here. I think there's an argument, and people I've talked to have supported this, of the Fed talking tough right now about inflation to make sure and play a role in the idea that the tariffs do not become a broader inflationary, have a broader inflationary effect, but then being ready as needed to address the downside. Right now, it seems like, because Powell feels like he's restrictive enough to deal with that inflation problem, that all the talk or the leaning here is addressing the potential negative effects of the tariffs, and the idea that they both brought down their growth forecast while they raised the inflation forecast. If this were the Volcker Fed, or the Volcker idea, Kelly, you would say that Paul Volcker would be addressing the inflation problem and then get to the growth problem.
Right, and Powell repeatedly says Volcker's the Fed chair that he kind of admires the most.
Yeah.
Granted, the inflation back then was very different than what we're dealing with now. Tom, even as the markets are digesting what Steve said, this kind of lower growth, stickier inflation environment, and not taking it all that well, what are the other positive signs you're seeing for stocks this week?
Well, I think that the sort of the big elephant in the room has been the absolute fear that has become systematic in markets around April 2nd and the tariff deadlines. And I think that there have been little hints this week that instead of April 2nd being the date of some sort of annihilation of trade relations, that we may start to see either deals before then or even delays in implementation. And I think that really investors are going to breathe a sigh of relief because, as you can tell, pessimism has become very pervasive because of the fears of what will happen on April 2. So I think that's a positive. And then the other is, and it's really a technical perspective, but Mark Newton, our head of technical strategy, has pointed out there are increasing signs of that we've actually established a tradable bottom. And that's not only the fact that we declined so quickly, but it's that market breadth has really been expanding and then actually following through in a way that looks like this is not a 10% decline that's leading to a 20%, but a 10% waterfall decline / heart attack for stocks driven by rage selling, and now it's tradable.
So those would be a couple of big positives, kind of technical signs, maybe April 2nd, because I've seen that reporting too, where they're, the White House evidently working with trading partners, trying to get some stuff dialed back before April 2nd.
Actually, that's quite interesting what you just say. He was talking about the waterfall pullback in stock of more or less 10% or 15%, depending on where the index you are looking at. Waterfall collapses mean like there's a sudden collapse. Not like slowly going down, but just like an abrupt collapse in less than a few days. Then you get 10% out of the S&P 500, 15% out of the QQQ, and 17%, 20% out of the MAX 7, or the same for the IWM. And that's very uncommon. That shows that, like I was saying, there is a lot of rage selling. People are they have knee-jerk reaction. They are panicking and they just sell, regardless of what the reality is about the tariff uncertainty, about the recession talk, about inflation, sticky inflation talk. So they really believe that the Fed is going to intervene. Whatever the unemployment market is going to be weak, whether the inflation is going to weaken, then they're going to decrease rate. They don't think that inflation is going to stay high. They think that all this inflation that you see from the tariff talk and probably the tariff that will be enforced will be transitory. And that's the key word of the Fed. They just reassure the market that everything that is transitory will not stay in the long term or the medium term. And it's all about short-term uncertainties, nothing more than that. And having that knee-jerk reaction just because of these small uncertainties that you've seen in the market and all this bearishness in the market, it's a clear technical sign. It's a clear technical sign that we are close to the bottom, like I explained to you over the last 2 weeks. When we have so much bearishness in the market, everybody already need like a rage sell. What is left for selling? And then we're going to see a rebound in the market. There is no doubt about this. This rebound will happen. And today already start to happen. I don't think it's going to be over. I don't think we're going to go for another leg down. Why? What would be the key catalyst for this another leg down in the market? So that's what you have to understand that. Okay, let's continue.
And so forth. What else, Tom, do you see that encourages you?
Well, I'd say that probably the final thing that I've seen is, and this is really from our meeting with clients, is that we know there's actually quite a lot of dry powder. Many of our clients have raised a lot of cash. I mean, it's also evident in a lot of the money market balances or prime brokerage de-risking that's taken place. And it's at a time when investor sentiment has moved far more than is justified by the market moves. Whether you look at AAII or Investors Intelligence, both have registered recession-like readings and sentiment. And so it really creates the room for positive surprise. And that, again, I think it'll, like what you just said, if Tariff had...
This AAII survey, it's actually a survey about all the market participants, and especially the institutional market participants, the level of bearishness, bullishness, and the neutral stance of the market. You can see, although the market hasn't really collapsed, as per se, there's just 10% down, 15 or 20% down, depending on what you look at. The bearishness level has never been so high in the market. We have to go back to the October 2022, even the financial crisis, to see this level of bearishness. And that has been always a clear sign of bottoming. And this is quite crazy to see this level of bearishness for just this small drop of the market. This drop is nothing what we've seen in 2022 or during the COVID time or even during the financial crisis. Nothing at all to compare. So this is what you have to bear in mind. If you see so much bearishness for something so small, that means the downside is finished. There's no fuel for the downside. no fuel for the downside to continue. You need new fuel for the downside to continue. Now all the fuel has been burned already. So the only thing left is positive upside surprise. And for me, it's not a surprise. It's something natural that will happen. The market will rebound and we go much higher from this level onwards. Doesn't mean we're going to reach all-time high. They're not going to have another catalyst in the coming weeks or days. I don't know the future. But if everything stays still like now, we're going to go up again.
Lines aren't as bearish, and if there's all this last-minute work on negotiating something, and yesterday there was a tweet about how into the night Hassett and Lutnick and Bessent were, working on a trade deal that got so little notice. I think it just tells me markets could be positively surprised.
Okay, that's it. Thanks so much for watching. I hope you had learned some valuable lesson, and now you're gonna stop to panic. Like the channel, subscribe, and leave a comment. Thanks so much, and see you next time. Bye.